It's crawled over 3%. It's taken a long time to get there. Our fixed income team was looking for 3 to 3.5 at the end of the year. So I don't think 3 was the line in the sand. I mean, a year and a half ago, the market may have thought that, but it certainly hasn't been the case. But I think if you really started to climb up over 3.25, that might be a little bit of a headwind. But the thing you have to think about is interest rates are higher because we only have slightly higher inflation and we have better economic growth. So it makes sense to me that the 10-year yield is a little bit higher.
Brian, we're making a lot out about investors breathing sort of a sigh of relief over some of the trade skirmishes because China said it's not going to devalue the RMB as a retaliatory effort, and China put levies of up to 10% on some of their goods as opposed to what was feared originally. But do we have actually more certainty than we had, say, 24 hours ago in terms of how far this goes?
Yes and no, Melissa. I think the certainties and realities that China really can't do anything have come to light, and I think investors are embracing that and maybe understanding it because they heard it. We're in one of these modes with respect to the market, quite frankly, and nobody believes it until they see it and they hear it. And I think that's why stocks have rallied so strongly here coming out of Labor Day. The majority of institutional investors were excessively negative in the third quarter, and now they're chasing up stocks at the end of the quarter with respect to performance. And quite frankly, that's still some near-term type of strategy that we don't like. But from a longer-term perspective, markets are still in their bull run, and I think Scott's spot on with respect to the treasuries. But we would caution people to not throw out a number. I'm sorry. And just worry more about the trajectory of interest rates, the trajectory of the economy, and I think most importantly, the trajectory of not only GDP growth, but earnings growth, and it remains positive.
Yeah, but decelerating. What about that, Brian?
Well, I would say this. If you take a look at the numbers that on a trailing quarterly basis, Carl, for the next 4 quarters, obviously you have tougher comps relative to 2018. 18 versus 17, you had easier comps. But at 11%, let's just say, back of the envelope, where numbers are right now, that's roughly double average earnings growth since 1990. So I think people are making a mountain out of a molehill. Everybody's trying to pick the top. I think that is the wrong thing to be doing. I think we should be embracing double-digit growth. And oh, by the way, we can make a case that double-digit earnings growth, let's say in the mid-teens, is actually too low because the majority of companies in America, especially from the industrial side, have not increased their CapEx, which we think is going to be a primary and major theme in 2019 and 2020.